We're all taught the golden rule of investing, diversify your portfolio. But what happens when that rule just breaks, right when you need it the most? Well, today we're going to dig into the deep science of building portfolios that can actually stand up to the fiercest market storms. Let's get into it.
And really, this is the question that keeps every serious investor up at night, right? You build this carefully balanced portfolio. You've got stocks, you've got bonds, and you believe they're going to cancel each other out. And yeah, most of the time that works. But in a real full-blown crisis, the entire game changes. And that safety net you thought you had, it just vanishes.
Just take a look at this chart. It shows the problem so clearly. See that blue dotted line? That's the normal relationship between stocks and bonds. It's low, sometimes even negative. That's exactly what you want for diversification. But now look at the red line, especially in those gray areas marking the crises. That correlation just spikes dramatically. All of a sudden, everything is moving together and your diversification is worthless.
Okay, so if we're going to build a portfolio that's truly resilient, we first have to understand why this breakdown happens. It's time to unpack the myth of foolproof diversification. It's almost like our portfolios live in two totally different worlds. On the left, you've got normal markets. Things are calm, correlations are low, and risk is spread out nicely. But on the right, you've got crisis markets. Fear completely takes over. Everyone makes a flight to safety. They dump everything at once, and that creates this contagion that turns all your different assets into one big systemic risk. There's actually a technical name for this hidden danger, and it's called tail dependence. You see, standard correlation measures, they often miss this because they're just looking at average, everyday behavior. Tail dependence, though, it focuses on the really extreme events, the tails of the bell curve. It's kind of like the statistical ghost in the machine that can bring an entire portfolio crashing down.
So how on earth did the quants and the big risk managers even model this kind of hidden risk? Well, they use a surprisingly elegant mathematical tool. Let's take a look at the math behind the meltdown.
This tool is called a copula. The name comes from the Latin word for a link or a tie. And what a copula lets you do is separate the behavior of individual assets from the way they are linked together, especially during those crazy market swings. It lets you model the dependency itself.
But here's the thing about powerful tools. They can be incredibly dangerous if you misuse them. This famous quote from Wired magazine is talking about how one specific type of copula, the Gaussian copula, was used to wildly, and I mean wildly, underestimate the risk in mortgage-backed securities. It basically became a central villain in the 2008 financial crisis. It's a pretty stark reminder that you have to understand the true nature of risk.
Okay, so we've diagnosed a problem. Correlations are not fixed, and this tail risk thing is very, very real. So now what? How do we actually protect ourselves? Let's pivot from the problem and look at a powerful and way more cost-effective solution.
Most people think of hedging as just buying insurance, like buying put options. But that insurance comes at a really high price over the long run. You're constantly bleeding away your money on premiums for a strategy that, let's be honest, has a negative expected return. But there's an alternative, a more strategic approach, like trend following, which actually aims to profit from those long downturns, making it a whole lot more cost-effective.
And wow, this chart right here really drives the point home. It shows how that approach performed across the 10 worst market crashes for a standard portfolio since 1903. Those purple bars, those are devastating losses. But look at the green bars. That's the trend-following strategy. It showed positive returns during the Great Depression, the '87 crash, the dot-com bust, and the 2008 crisis. It worked as a powerful hedge again and again.
But of course, there's always a but, isn't there? Markets evolve, things change, and the simple version of this trend-following strategy actually ran into some trouble in our more modern market environment. It needed a crucial upgrade.
Yeah, see, the world really changed after the 2008 crisis. We entered this new era of super high correlation across all different kinds of assets. And in that environment, the simpler trend-following strategies just started to lose their edge. The very problem we talked about at the beginning, those rising correlations, came back to challenge the solution itself.
It all comes down to how you build the portfolio. The traditional method, which some call naive risk parity, it only looks at the volatility of each individual asset. It has a huge blind spot. It completely ignores how they're all correlated. In contrast, true risk parity explicitly accounts for those correlations. It weights assets based on their actual contribution to the portfolio's total risk, and that makes it so much more robust in the high correlation world we live in today.
So what have we learned through all of this? Let's bring it all home and quickly summarize the key takeaways for building a portfolio that's actually truly resilient.
All right, first, you got to remember that correlations are not static. They can and will spike in a crisis. Second, you have to get your head around tail dependence. That's the hidden risk that gets everybody. Third, think about strategies like trend following as a smarter, more cost-effective hedge than just buying expensive insurance. And finally, to make that strategy really work today, it has to be correlation aware, using a true risk parity framework.
And that really leaves us with one last, and maybe the most important question to think about. The nature of risk is always changing. As markets evolve and new regimes pop up, the tools we've talked about today can help us see the dangers of the past, but the real challenge is to keep asking ourselves, what hidden links, what new kinds of tail dependence are we ignoring right now? Thanks for tuning in.